Sophie, where do you see the best value right now? It does look like, companies and industries are doing well are also very, very expensive.
I guess that it really depends on the macro scenario you have. Investors are talking a lot about bubble at this point, at a time where in terms of equity positioning, it's not stretched. And we've seen more outflows from equities rather than inflows since the start of the year. Having said that, if you have an L-shaped scenario, then investors will continue to buy growth and the tech and their bond proxy. So even if they're expensive, you'd rather buy this because they will perform well, whichever the scenario. If you're more in a swoosh scenario, then the big question for me in the second half of the year is really value versus growth.
Sophie, does anything feel like it's in bubble territory right now? Is there anything that looks risky?
What we're looking into at the moment is whether we have another tech bubble. Something to keep in mind, though, is that when you look at the EBIT margins of the tech companies, it's way higher versus the rest of the U.S. equity market. So it's something to take into account, even if, as you were mentioning, there's all this antitrust, digital taxation, but also this social media scrutiny that could potentially weigh on the tech sector. So, if you have a swoosh recovery and this regulatory issue going on, then it could constitute a trigger for the underperformance of NASDAQ versus mid-caps in this context.
A lot of the focus today, Sophie, will be on a lot of the technology stocks and the FANG stocks because of hearings. What is the biggest risk for FANG stocks right now, or in general technology stocks? That they're expensive or the regulation aspect?
I think it's more, as a trigger, it's going to be more a regulatory aspect. You have several things going on. As I was mentioning, digital tax, which is not only U.S. but broader OECD, so this is still ongoing. The regulatory side, it's much more on the antitrust at the time where, the top 15 companies of the S&P represent 16% of U.S. GDP. It's unprecedented, and it's really showing that there's an issue going on. So I think the regulatory side of things is more a trigger rather than how expensive they are. Because how expensive they are, it's more in the macroeconomic context you need to take into account. And you'll be ready to continue buying expensive things if you're uneasy about the economic scenario.